everyone. Today we are going to cover another topic, that is accrual accounting. That helps you to record advanced transactions in the accounting equation. So let's get started. Before moving to our topic, it is important to understand what is meant by this term, the reporting period, or you can say the accounting period. In accounting, we believe that an entity is a going concern. That means the entity operates indefinitely until it provides evidence to the insolvency. Stakeholders, those who are interested in the business, want to know about the financial status on a regular basis. Therefore, for the reporting purpose, the life of the entity is divided into arbitrary reporting periods, which is also known as accounting periods. For the external stakeholders, the financial year is usually 12 months. For the internal purposes, managers' decision-making timeframes could be less than 1 year. So let's take an example. Our calendar year falls from the 1st of January to the 31st December, but the reporting period could be different. In Australia, the financial year falls from 1st July and runs until the 30th June in the following calendar period. So as in, a financial year can start and end at any point during the year as long as it comprises a full 12 months. So let's get back to our topic. What is the difference between cash accounting and accrual accounting? The key difference is the timing of recording income and expenses. They both give the same results over time, but at a certain point in time, there are differences. This is very important because accounting standards require that financial statements are prepared on accrual accounting basis. Let's start with the cash accounting. This is simple and easy to understand. It recognizes the transactions only when cash is actually exchanged. The income is recorded when cash is received and expenses are recorded when cash is paid. So in this concept of recording, it only matters when the customers actually paid, and the same thing is for the expenses. Whether you purchased on credit doesn't matter, you do not require to record it until you actually pay for those expenses. For example, if you send an invoice on Monday and don't get the payment in your account until Friday. In cash accounting, you record the income on Friday in your accounts. So within the accounting period, according to cash accounting, it records cash inflows and cash outflows. This is the fundamental principle of constructing the statement of cash flows. We are going to touch that in our later tutorials. Also, smaller entities who do not need to comply accounting standards can produce their income statements based on this concept. Alright, let's move to the accrual accounting concept. We record when the transaction happens regardless of when cash is exchanged. So the income is recorded when it is earned and the expenses are recorded when they are incurred. This way of accounting shows the amount you owe to people and the amounts owing to you. For example, if you are a builder and send an invoice for a project that you have completed recently, you record the sale in your accounts even though you have not received the payment. The purpose of accrual accounting is to better reflect the financial performance during the reporting period. Therefore, entities, those are required to comply with accounting standards, must prepare its financial statements according to the accrual concept. There are 4 key transactions that need to understand carefully when recording on accrual basis. Let's go one by one. The first one is accrued income. During the accounting period, business has provided goods or services to a client and issued an invoice. The income is earned during the period but not received in cash. The invoice will be paid by the customer in the next accounting period. But according to the accrual accounting, income is recognized without the receipt of cash. The second transaction is related to income received in advance. During the accounting period, business received an upfront payment from a client. The business is going to provide goods or services to the same client in the next accounting period. In the current accounting period, we should not recognize any income because the business has not rendered any goods or services to the client. The amount received increases the cash account, but this must be treated as a liability until the income is earned, because the entity is now having an obligation to provide goods or services in response to the receipt of this upfront payment. The third transaction is accrued expenses. Say for instance, the business has not paid for the June telephone usage. The expense has been incurred, but the telephone bill will be paid in the next accounting period. The expense associated with June telephone usage must be recognized as an expense because the company had been using the telephone during the last month of the accounting period. Therefore, expense is recognized without payment of cash. Okay, let's move to the final important transaction related to accrual accounting. That is prepaid expenses, or you can call it as prepayments. Company make an upfront payment, so the cash asset decreases. Part of this payment may be relevant for the same accounting period, or the entire amount could be relevant for the next accounting period. So whatever the amount which is not incurred should not be recognized as an expense in the current reporting period. Rather than, it should be recognized as an asset until the economic benefits are used or consumed. Let's record these transactions in the accounting equation. We are starting from accrued income. The transaction is Star Cricket Coaching invoiced $2,000 on 28th June 2020, but the invoice had not been paid by the member. The reporting period ends on 30th June 2020. The coaching service is already rendered, therefore the income is earned during the reporting period. It increases equity by $2,000, and on the other hand, receivables goes up by $2,000, which is an asset. The customers will pay the amount in the near future. This is also equal to the credit sales, which we have discussed in our previous tutorial. The second illustrative example is about income received in advance. Star Cricket Coaching received an upfront payment of $5,000 to conduct a training session in August 2020. Cash asset goes up by $5,000 with the receipt of this upfront payment. However, service is not yet provided and it is scheduled in August 2020. That means in the next accounting period. So it creates a present obligation in the current reporting period. Therefore, liability goes up by $5,000. The next illustrative example is about accrued expenses. Star Cricket Coaching's estimated telephone charge for June is $500. This account will be paid in July 2020. The telephone usage for the last month of the accounting period is an incurred expense. The economic benefits used by the entity. So equity goes down by the estimated expense amount, that is $500. On the other hand, accounts payable goes up by $500, which is a liability. So it creates an obligation to pay for the expenses incurred during the period. Okay, moving to the final illustrative example, that is about prepaid expenses. Star Cricket Coaching paid $3,600 for 12-month premium for public liability insurance at the start of June 2020. The reporting period is 1st July 2019 to 30th June 2020, and the insurance is paid at the start of June 2020, and that is for 12 months period. It is necessary to consider what expense has been incurred during the reporting period. The entity has received the benefit for only 1 month of the insurance premium at the end of this accounting period. So this figure must be computed and recognized as an expense in the current reporting period. Therefore, the amount would be 3,600 divided by 12. That gives you $300 of expense. And the remainder is a prepayment. Let's go record this in the accounting equation. Cash goes out, so the asset decreased by 3,600. Only 300 is relevant expense for the current accounting period, so equity goes down by 300. And the remaining 3,300 is a prepayment that must be recorded as assets until economic benefits are used in the next accounting period. So now our equation balances. So far we have covered 22 illustrative examples as a part of transaction analysis over 3 tutorials. If you have any questions, please feel free to put your comments below. Let's meet again in accounting equation part 5, that is going to be the final touch-up in the accounting equation. We are going to record the transaction into the accounting worksheet, and we are going to use Microsoft Excel. And the summarized information is used to construct basic financial statements. Thank you.